Here is the contradiction that opens the whole issue. On July 1st, the memory and artificial intelligence hardware complex was dumped. Micron fell more than 10%. Memory and chip equipment names dropped 7 to 10% across the board. And yet the S&P 500 barely moved, down just 0.2%. A 10% day in the highest beta corner of the market, and the broad index shrugged. That gap is the whole story. Now here is what everyone was chasing. In the first half of 2026, the semiconductor group ran up more than 80%, the most crowded trade on the tape. Then, in a single session, it flinched. The pure compute rental names, the neo-clouds, fell as much as 17% on a report that Meta will start renting out its spare artificial intelligence capacity. For the first time this cycle, the market asked out loud, what if all this compute is about to become a glut? So where is the edge? Not in the crowd and not in selling artificial intelligence. It is in one distinction the market just made for you. The commodity middle of the stack, undifferentiated compute for rent, is where a glut lands first, and it fell 17%. But the genuinely scarce input, high-bandwidth memory, is sold out through 2026, contracted, unaffected. The glut hits the middle, position at the ends. This is the asymmetric. This is the asymmetric, issue 34, the glut test. Tech and crypto investing for thoughtful retail, from an operator's lens. Yesterday's issue named the bullish half of a single event, Meta selling its excess compute. This morning, the market read the same word, excess, the other way, and dumped the memory and artificial intelligence hardware complex. This issue is about what that rout actually graded. Here is the one-line read. On July 1st, Micron fell 10.6%, SanDisk fell the same, Applied Materials, Intel and Advanced Micro Devices dropped roughly 7 to 10%, and the pure compute rental names fell as much as 17%, after the whole group had run more than 80% in the first half of the year. Yet the S&P 500 fell just 0.2%, and the Nasdaq 0.2%. The damage was concentrated. The trigger was not an earnings miss, it was a narrative flip, a report that Meta is building a business to lease its idle artificial intelligence capacity, now read as latent supply. The owners of the machine rose, Meta, Microsoft, and Apple, while the vendors into it fell. And the macro turned dovish on hard data. June payrolls rose just 57,000, well below the 115,000 expected. Gold ran toward $4,135, the dollar slipped to a 2-week low, and Bitcoin reclaimed 61,000 after the Federal Reserve chair said inflation risks had eased. You'll see the same labels throughout. Confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, a narrow route the index absorbed, under a dovish jobs print. 30-second frame. 1. The sell-off was surgical. The Nasdaq fell 0.2% and the S&P just 0.2%, while memory and neocloud names dropped 7 to 17%. 2. The catalyst was a narrative flip, not a data miss, a report that Meta will rent out its excess compute. 3. The macro turned dovish on hard data. June payrolls rose just 57,000 against 115,000 consensus. 4. Cross-asset confirmed it. Gold ran toward 4,100, the dollar slipped to a 2-week low, and Bitcoin reclaimed 61,000. And 5. The tale is calmer. Oil sat near pre-war levels as the Strait of Hormuz normalized. Start with the rout. On July 1st, the memory and artificial intelligence infrastructure complex was dumped. Micron fell 10.6%, SanDisk the same, Applied Materials about 10, Intel about 9, Advanced Micro Devices about 7, with Samsung and SK Hynix down 7 to 9% overseas, and the compute rental neoclouds worst of all, down 14 to 17%. The group had run more than 80% in the first half. And yet the S&P 500 closed down just 0.2%, the Nasdaq 2/3. A 10% drop in the highest beta corner of the market moved the broad index barely at all. That is the opposite of contagion. The consensus says the artificial intelligence top is in, sell the leaders. Our variant, this is a dispersion event, not a direction event. Sort the wreckage by scarcity, don't sell the whole trade. Now the catalyst, and the word doing all the work is excess. The trigger was a report that Meta is building a cloud business to lease its idle artificial intelligence data center capacity, the same report that lifted the stock 10% the day before. For the owner of the machine, selling excess is a revenue line. It monetizes a sunk cost. But for the sellers of undifferentiated compute, a giant renting out spare chips is a price war and a glut signal at once. The tape sorted it in real time. The platform owners rose, Meta about 9%, Microsoft about 3%, Apple about 2%, while the vendors and the neoclouds fell hardest because Meta would compete on their turf with capacity it already owns. The consensus reads this as artificial intelligence demand peaking. Our variant, commodity compute gets cheaper, while scarce inputs, memory, power, and platform relationships are unaffected or even helped. Macro 3, the dovish turn. A soft jobs print pinned the Federal Reserve and lifted the drain assets. June payrolls rose just 57,000, well below the 115,000 consensus and the weakest in months. Unemployment was 4.2%, though helped down by falling participation, and wages rose 3.5%. Markets read the Fed as having little pressure to tighten. Gold climbed toward $4,135 on the lower rate impulse, cited by Level and Driver, never a contested return. The dollar slipped to a 2-week low, and Bitcoin reclaimed 61,000, up about 4% off a 58,000 low, after Federal Reserve Chair Kevin Warsh at the European Central Bank's Forum in Sintra said inflation risks had eased. This is a notable shift from yesterday's hawkish framing. One-week print reframed the debate from hike versus hold to hold versus cut. Our variant, the print pins the Fed on hold, not cutting, and the durable signal underneath is a cooling labor market. Part 2, in focus, the epicenter of the rout is the least glut-exposed name in it. The in-focus name is Micron, and the stock at the center of the rout is, on its own numbers, the least glut-exposed. Micron fell 10.6% on July 1st, yet it remains up about 260% for the year because the drop was a group repricing, not a company event. Just days earlier, on June 24th, it reported a record fiscal quarter, with revenue of roughly $41.5 billion against $9 billion a year ago. Gross margins near 85%, high-bandwidth memory sold out through 2026, and a forward guide raised sharply toward $50 billion as its newest memory for NVIDIA's next platform ramped. High-bandwidth memory is not commodity chips. It is a scarce, allocated input sold under multi-quarter agreements to a short list of buyers. Sold out through 2026 means the price and the volume are already contracted. Now the mechanism, why a compute glut hits the middle of the stack, not the ends. Layer 1, the scarce input holds. High-bandwidth memory is contracted through 2026. A giant renting out spare chips does not create spare memory. Micron's glut exposure is in commodity memory, not the sold-out franchise that drove the re-rating. Layer 2, the commodity middle takes the hit. The neocloud product is the compute tower itself, undifferentiated. And if Meta enters with chips it already paid for, it can price below a pure play whose entire cost is that same chip. That is why CoreWeave and Nebius fell 14% and 17%, and Layer 3, the platform owners hold because they monetize the excess. The market threw the scarce input out with the commodity capacity. The glut, if it comes, arrives in the middle, position at the ends. The debate, the bull, the input is the thesis. The epicenter of the glut sell-off is the one name whose flagship product is physically sold out and contracted. The 10% drop is group beta, not thesis damage, and the raised guide is intact. The bear, priced for perfection. Micron is up about 260% for the year, into a cyclical peak, and a move that size prices a lot of good news. If accelerator demand slows, even sold-out memory reprices at the next contract cycle, and the commodity side of the business is genuinely cyclical. Memory is the most boom-and-bust segment in technology. Every upcycle has ended in oversupply. The referee is the memory contract cycle, price, and backlog. The read, a research view, not a call. Micron is this issue's spine in one name, the 10% epicenter that is, on its own numbers, the least glut-exposed name in the group that sold off as if it were the most. The scarce input side is real, memory sold out through 2026, a record quarter, contracted demand. The risk side is equally real, a scarce franchise sitting inside a stock up 260% for the year, with a genuinely cyclical commodity tail. The discipline is not buy the dip, it is to distinguish the sold-out input, the thesis, from the 260% move, the risk. What would change the read? Memory contract pricing or the forward guide gets cut and the scarcity is breaking versus the newest memory keeps ramping sold out and the backlog rises. Step back to the dividing line, scarce inputs and cash machines versus commodity capacity. A 10% day across artificial intelligence hardware is not one trade. It is the market pricing the difference between latent supply, the idle chips a giant can rent, and genuine scarcity, memory that is physically sold out. So own the scarce input, sold out memory under multi-quarter contracts, scarce baseload power, inputs a glut cannot manufacture. Own the self-funding machine, the platform owners that monetize their excess, and the hyperscaler that funds the biggest build on Earth from its own cash. And price commodity capacity as an option, the pure compute rental names, undifferentiated, facing entry by better capitalized incumbents, the part of the stack a glut hits first. Part 3's thematic signal, the state capitalism turn. The Financial Times reported that OpenAI has begun preliminary talks to give the United States government a 5% stake, worth roughly $42 billion at its recent valuation, as part of a pitch under which Washington would hold 5% of each leading American artificial intelligence lab, pooling the upside in a public wealth fund. It is early stage, likely needs Congress, and is unconfirmed by the other firms, so treat it as reported, not closed. This is the same state capitalism turn the letter has tracked. The upside is a permanent policy tailwind and a regulatory moat for the incumbents. The downside is political control, dilution, and a free market backlash already visible in Congress. The operators read, the biggest artificial intelligence winners are increasingly policy assets, which raises both their durability and their political risk. Part 3, the read, the glut if it comes, hits the middle, position at the ends. What we are watching over the next 4 weeks, whether Meta confirms and prices its compute business, which decides if the glut is real or a one-day overshoot. The neoclouds, CoreWeave and Nebius, as the merchant compute tell, the Federal Reserve's next decision, hold versus cut, in about 4 weeks. The July jobs report to confirm or refute the June cooling. Megacap earnings and their capital spending guides. The memory contract cycle, the scarcity test for Micron. OpenAI's government stake pitch, gold against $4,000 and the dollar, and whether the rout stays contained to the vendors or broadens to the top of the index. The scorecard, our open, dated, falsifiable calls tracked publicly, dispersion not direction. The rout is a subsector repricing the index absorbed. Micron, the least glut-exposed name in the sell-off. Macro, a soft print pins the Federal Reserve on hold. The glut test, the stack graded by scarcity. Crypto, a dovish cushion and a liquidity rotation. Gold, cited by level and rate driver. Meta, own the machine, price the cloud as an option. And the state capitalism turn, the artificial intelligence winners become policy assets. Full detail lives in the assumptions ledger. The bottom line, the rout graded the artificial intelligence stack. It did not end the trade. A 10% one-day repricing hit the commodity middle, memory beta and compute for rent, while the broad index fell just 0.2 and the platform owners actually rose. The market was pricing the difference between latent supply and genuine scarcity, and a soft jobs print handed the whole complex a dovish cushion, lifting gold and Bitcoin on the same tape that dumped chips. So the operator's move is surgical, not directional. Own the self-funding cash machines and the truly scarce inputs. Treat undifferentiated capacity, the part a glut hits first, as an option, not the thesis. Research and educational only, not financial advice. This has been the Asymmetric, Issue 34.